The venture capital ecosystem has to change.
Survival isn't mandatory.
It doesn't mean that you're destined to die. It just means you have to work harder.
Venture capital is undergoing massive change. Think back 10 years ago, the tech ecosystem was a fraction of what it is today. In the last decade, we've gone from 1 to 2 new unicorns each year to hundreds, from 45 billion of venture capital deployed to over 300 billion being deployed in 2021, and from just under 500 venture firms in existence to today there being over 2,000. Yes, there has been a public market correction, but the fact remains venture is changing faster than ever, and venture capital firms are going to have to adapt. Today's guest is Frank Rotman, co-founder of QED, one of the world's best-known fintech venture firms. He's going to walk us through a framework for understanding the types of venture firms that will thrive in this new reality. So Frank, welcome to the program.
I'm very happy to be here.
It's great to have you. So as a founding partner of QED and one of the kind of leading fintech specialists, VC, you spend a lot of time thinking about both the future of fintech, but also the future of the venture ecosystem. And so what I want to dive into here is a piece you wrote called Three Body Problem, Finding the New Stable Points in Venture Capital. And I like the quote you had at the very end of the piece, actually, which was, it is not necessary to change. Survival isn't mandatory. You are saying there are 4 stable points in venture capital, right? So what are those 4 stable points?
It's very interesting to look at any given industry when there's been a bunch of changes over an extended period of time. And I think that's really the origin of this paper. And I think it's important to start there before we jump into the new stable points. Industries change when a lot of the forces that drive whatever the result is in that industry change. And I think if you actually look at most venture capital firms, they're structured almost identically to the way they were structured 20 years ago, 30 years ago. If you look at how they operate, they haven't adjusted when both of the inputs to the venture capital world have changed massively. You have the LP ecosystem, which is basically the fuel that they need to bring into the VC firm in order to deploy. And then you have the actual companies. And probably most notably, the companies have changed a lot. You know, the Cambrian explosion of startups, what it takes to actually go from 0 to 1 in startup land, the number of people who have been around the cycle so many times so that they know exactly how to build these things.
20 years ago, 0 or not 0, 5, 10, 15 unicorns. Today, 700-ish unicorns. Yeah, so there's like massive. And then the capital, too, to your point, tens of billions per year to now hundreds of billions per year.
And if you even look back to 10 or 15 years ago, traditional venture capitalists, they were looking at exits that were, a few $100 million if it was bought by another private company. And then if they went public, they were looking at a single-digit billion-dollar valuation on a company. And that's changed so much as well about the outcomes. So not a surprise that an extended period of change, both in the LP ecosystem and in the startup ecosystem, is causing some changes. So the 3-body problem really outlines some of the new stable points that are emerging. And you're actually seeing this play out live. The 4 stable points that I define in the paper, one is scale. The second one is non-consensus alpha, or really think of it as first check writers into very, very unproven ideas with unproven founders. The third is the late stage generalist, and the fourth is the solo capitalist. So 4 very distinct points that if a venture capital fund, wants to find themselves in a spot where they have a purpose, like a reason for existence in the market, and they can configure themselves in a way that they have competitive advantage in the market. These are 4 of the stable points that I see happening. So if you have people who want to give you the money and you have the best startups that want to take your money, it's a very stable point and you can generate great returns.
Yeah, totally. Sometimes people in an industry forget that their industry is maybe similar to other industries that have come before, and you can kind of learn lessons from the past. So I know you compared the venture capital industry to, say, consulting, banking, or accounting in the 1980s, and you use the 3-body problem as a metaphor. So would love to dive in first to just the 3-body problem, what that metaphor is, and then how that applies to kind of some historical antecedents?
The three-body problem, it's an old problem in physics. It's the name given to the challenge of determining the motion of three celestial bodies that are moving under no influence other than that of, each other, the mutual gravitation. So it's actually a really difficult problem to solve. It collapses to a problem that you can solve and solve well when two of the bodies are gigantic and one of the bodies is very small. So the small body has these forces that are being exerted on it, and you can find stable points where that middle, smaller body actually can sit without exerting energy, right? It's not being pulled by one, it's not being pulled by the other. It actually can stand its ground without having to exert a lot of energy, and these are called Lagrange points. But the four stable points of venture capital that I outline are really finding the Lagrange points of this startup ecosystem, where the large body are the LPs. Another large body is the startup ecosystem, because you have tens of thousands of LPs and you have tens of thousands of startups. And if you think about any individual venture capital fund, it's small, right? You might be a few people, you might be a few dozen people, you might have a small amount of capital, you might be able to back a few companies or a few hundred companies, but no matter what, you're the small body, right? And you have a many-to-many matching problem of finding LPs that want to give you capital and find great companies that want to take your capital. So as these two industries have changed, like these two giant bodies, the LP ecosystem has changed and the startup ecosystem has changed. The venture capital ecosystem has to change as a result. As an example, in the fintech ecosystem, when we first started investing back in 2008, I think the number that year was about $1 billion worth of capital was deployed in fintech. And last year it was 140 billion. It used to be that just a few of us could cover everything that was happening in fintech. And now if I took all day to just read the information that comes across my desk, I would be farther behind than ahead every single day.
That's the general metaphor being applied here. But then let's look at some of the historical antecedents in terms of thinking through other industries that started out highly fragmented in some sense, similar to venture capital, but then experienced kind of new rotations and stabilization.
The metaphor is basically saying that there are drivers of change in an industry. And when those drivers of change are persistent long enough, the industry has to change. And in consulting, you can actually look at what's happened, and you now have a couple gigantic consulting firms where scale actually matters, right? And you have some consulting firms that are specialists, and that's a very stable point in consulting, where they know one thing really well with expertise, and they can do well. The same thing in accounting. Mergers enabled firms to achieve greater economies of scale and ultimately increase their market share, maintain their market position. The smaller firms just did not have the scale over time to afford to build any of the infrastructure that they needed. The bigger teams can source and process more deal flow. So the scale benefits of just being able to see so much more and process more deal flow is just massive. So I think scale is one of the most, obvious places where LPs will throw money at you. And at the same time, the companies in the ecosystem want to take your money.
I'd love to dive into some of the, less obvious Lagrange points.
Yeah, so the second one is almost a back to the roots of what venture capital is, which is non-consensus alpha, right? And what that really means is taking a founder who's trying to start a company and pair it with an idea that is so novel that people haven't seen the story play out in the past, right? So you're taking unproven founders and you're taking unproven ideas and you're giving them capital to basically de-risk a business and prove whether they're right or wrong, right? And with the explosion of companies, company formation in the ecosystem, like there is plenty of room for first check writers in the space. And again, there can be an explosion of non-consensus alpha players that can specialize in different things, right?
And they usually invest very early.
Well, and first round capital by definition, like it is the first check, in a lot of these companies.
And I think the non-consensus alpha bucket is kind of the romanticized notion of what most people believe venture capital to be.
Yeah. I mean, the value proposition of a non-consensus alpha player to founders is that they can get to yes when everyone else says no. Right? Like that is the value proposition.
And then moving on to the next bucket here, kind of the late stage generalist.
So eventually a company gets large enough and mature enough that you start to think about exits. And an exit really is just the beginning of another stage, in the company's life. They understand public markets really well, which is, again, a very different set of investors, and turning over the old investors into the new ones, what it takes to make those new investors happy. So the late stage generalists are great at being kind of the last round of capital before a de-risked company is ready to go public. And it's much more about the hygiene of putting the money in for the right things so that, again, this turnover of investors, can happen and the company can start the next stage of its life.
And then last bucket, which is one that's near and dear to my heart, the solo capitalist bucket.
Yeah, I mean, look, solo capitalist, it's usually an individual where the reason why a company will take their money is because of who they are, the very specific expertise that they bring to the table, and the fact that they are not going to be the primary investor. They are going to be pound for pound the best investment dollars that can be taken by the company. And then they bring the expertise to really kink the curve on outcomes. So there are deals that we do where there are a number of solo capitalists who I'm, very close with, where if they have the right skills for that company to carve off $100,000 allocation to a solo capitalist, no big deal in a $10 million round. And pound for pound, now you're getting their Rolodex and their expertise and the advice that they give to the company. So that is a very stable point. And in fact, if I'm honest, where QED started, it was probably closer to the solo capitalist bucket than non-consensus alpha.
That's exactly what I want to touch on next is like, what has the QED story been within this framework in terms of where the firm started and where you put yourself on the map today?
Well, early on, there only were, three of us at QED. It was Nigel Morris, Caribou Honig, and myself. All of us had operating backgrounds. We helped create what became Capital One. So we always called ourselves operators masquerading as investors, right? Which in some ways is the definition of a solo capitalist, right? There's something distinct that we had that people wanted. And we had a limited capital base, which was our own capital, right? We didn't raise any outside capital, so we had to write modest-sized checks. And we didn't lead rounds, but we tucked ourselves into rounds that were coming together from others. Eventually, we built up our expertise so that we felt comfortable writing lead checks. Eventually, this fintech thing became real, and we started expanding our team, expanding the expertise. And eventually we had to cross into the world of raising capital from outside LPs because the opportunity was just bigger than our team and bigger than our capital base. So, yep. I mean, we're now investing out of $1 billion fund. We have 21 investment professionals globally. We're just about to hit our 200th investment. We have 27 or 28 unicorns under our belt where we were the first or second check into companies. It's not the same thing as it was when we first started.
What were, when the first 2 years of operations, like talk through one or two checks into one or two companies you made. How big were they? What were the companies?
Yeah, I mean, Nigel and I had worked together for a long time. I mean, as of August this year, we've been together 29 years. But we knew that we were basically a fintech of the, 1990s, Capital One, right? Taking on the big incumbents and our skills and what it took to actually crack the code on a business and scale it. So we actually were in stealth mode for a number of years. Nigel was a special advisor to General Atlantic and a number of other bigger firms. And when we decided that this is something that we wanted, there's no deal flow actually coming across our desk except a little bit that came across Nigel's. So it was really about just calling all of the VC firms and private equity firms and saying, hey, we're in business. Like, if you see deal flow that is in the financial service or fintech world, Like maybe we can be a second set of eyes for you. Maybe we can help you with diligence. And the original product was really just being helpful to everyone else.
When would you say was the next kind of stage out of, the pseudo solo capitalist bucket into like non-consensus alpha, would you say? And I'm curious with like your investment into Credit Karma, would you characterize that as a non-consensus alpha investment or?
Yeah, so in our early days, we did have a number of non-consensus alpha plays where we understood the business so well that we were confident enough in leading a round. But rounds back then were very small. So we were the lead in Credit Karma Series A, which today would be a seed round, right? So if you actually translate it into today, you're talking the company had 6 people and no revenue. It was non-consensus alpha because, Ken was probably 2 weeks away from being bankrupt. And he had already been told no about 100 times. So definitionally, getting to yes when everyone else says no, like that's exactly what happened with Credit Karma. And the reason why it happened is because it was so easy for us to understand like what this business would look like at scale and why it would be valuable in the ecosystem and how big it actually could be.
So for QED now, do you still feel like you're a non-consensus group to some extent? Or are you like trying to think about how to build yourselves into a scale shop?
So we are unique in a number of ways. So imagine 20 some odd investment professionals globally. Imagine a world with a support team of about a dozen individuals that have other things that can fill in the gaps, like helping with recruiting and PR and a few of the other skills that are needed in the space. And the advantage that we have with the scale that we have and the global footprint that we have is that we're able to actually connect dots about what's happening in geography A to geography B or industry A to industry B within this specialty called fintech, right? And fintech is now 20% of all deals, right? It's not like it's a small thing. So even though we're specialists in something that's quite large. If you look at almost any stock exchange around the world and you look at the top market cap companies, a number of them are banks. And it's not because they're lucky. It's because there's a ton of profitability still in the core function of banking. And there still are tons of unsolved problems. So we believe that this is a durable category. So we are moving into an at-scale specialist. But we have the advantage that if we want to, we can dip our toe into non-consensus alpha plays. Like we have the ability to do that as well because we're ex-operators and we're not scared to build.
What concluding thoughts do you think there are for kind of thinking through this 3-body problem and where venture is?
So I don't want people to mistake like this framework for saying that if you don't fall nicely into a bucket, like you're dead. Like that's not what the framework is meant to represent. Just like the physics problem, if you have these 2 bodies and you're not in a Lagrange point, it just means you have to work harder to maintain a stable orbit. And there are a lot of strategies that will work, and there are certain partnerships that they have a dynamic that's so healthy, like that they're going to succeed. They might have to work harder for it. A lot of these firms, when they saw this 3-body problem piece, they're like, I don't fit in one of those buckets. Are you calling me bad? Right. And that again, I'm not. I'm just saying that the points that I'm outlining as stable points are probably the ones with the least amount of effort if you can find yourself cleanly in a box.
No, I think one thing that came away from me with this conversation too is, yes, these are the buckets today, but these are not fixed buckets forever. Like they weren't the case in the past. They probably won't be the case in the future. So the buckets themselves can of course change. But then we also talked about how like QED's positioning in any of those buckets has evolved over time. And I think we could actually probably just go back. This is what you had at the conclusion, but I put it in front, like, it's not necessary to change. Survival isn't mandatory. And so a lot of people are changing as the categories change.
That's a lot of the advice I give to friends of mine. They're like, wow, I saw this deal, but it's so competitive and there are all these firms that are looking at it. And like, I don't know how I'm going to win the deal. And I talk to them and I say, well, it sounds like you're in a lousy bucket. Like, why are you going after that company and go hunt for companies where they want you? Figure out if your strategy is the right strategy. And are you hunting in the place for which you are the number 1 pick?
Well, Austin, this has been super informative and enjoyable. So thanks so much for coming on and sharing some of your thoughts.
My pleasure.
Thanks for joining us. Hope you enjoyed this conversation with Frank. If you'd like to see more content like this, hit the like button or smash subscribe. Catch you next time.